and now we're ready to start actually compiling the cash flow statement. So, like all of our statements, we're going to start with our heading. So the name of the company, statement of cash flows, and we do want to specify which method. We're using the indirect method here. And this is for the year ended December 31st and the year. Okay? I'll center that in a minute. So remember our sections. Oh, it flows. Operating, investing, financing. So to start off with, we're going to put cash flows from operating activities. And to start with the operating section, again, at least as far as indirect method, we're going to start with net income, and we're going to adjust it for any non-cash items that we can find on the income statement. And then we're going to take and add in the changes for current assets, well, add or subtract, but we're going to take the impact of changes in current assets and current liabilities. We're trying to take net income and convert it to a cash basis. So if we go back to our income statement, our net income was $12,900. So we're going to put that in our cash flow statement. Okay. After that, we want to take and adjust it to make it cash. So we're going to put adjustments to reconcile net income to cash. Again, the whole point is to turn this $12,900 into a figure that actually equates with cash either received or paid from operating activities. So when we looked through that income statement, we found one item on there that had nothing to do with cash, and that was depreciation. Depreciation expense subtracted from net income, or it decreased our figure to get to net income. So since it doesn't have anything to do with cash, we need to add that back. So we'll go over and put that figure here. Now, if we saw anything else on the income statement that didn't have anything to do with cash, for instance, amortization expense, or if we had gains or losses, okay? Amortization expense also would have deducted to get the net income balance, we'd want to add it back. Or if you had a gain, like you sold a piece of equipment and you sold it at a gain, well, the sales price itself we would record as cash if you got the sales price in cash down in your investing section. But the gain would have increased net income. Well, it doesn't have anything to do with cash, so we need to get out of there. We'd want to deduct it. And by the same token, if you had a loss, when you made your entry up, if you sold something and had a loss, the cash part we would already have down in the investing section, but the loss has been deducted to get that net income figure. It doesn't have anything to do with cash. We need to add it back. We didn't have any of those this time, but we definitely want to look for those to make sure we didn't need to pick any of those up on a cash flow statement. After we look through the income statement, that's when we just go back to our comparative balance sheet and look at those differences between our current assets and our current liabilities. So we're just going to look down. We've got, you don't put cash in there now. Remember, the whole point of the cash flow statement, that's the answer we're trying to get to. So we don't want to include the answer in the calculation. That would throw things off. So we've got accounts receivable, supplies, and prepaid insurance. Okay, accounts receivable went up. So let's go over here and put, let's put increase in accounts receivable, right? And how much was that for? Went up $1,400. Okay, so think about it this way. If accounts receivable went up, more people owe us money. We would have recorded the services provided in that same period because we actually did earn the revenue. But did the revenue have anything to do with cash? Did we get their cash yet? No, not for this increase. This increase shows that we provided services and we haven't gotten that amount of increase yet. It's sitting in the receivable. But the revenue side of it went through income, so it's reflected in the income statement. But the cash we haven't received yet. So we need to deduct that increase out of the net income figure. In general, you can remember that current assets we do the opposite. Current liabilities we do the same. think about accounts payable. And we'll go ahead and look down there so we can talk about it. Accounts payable went down $90, decreased. Well, that means that we have less owing than we did before. We owe someone less, so we must have paid a little bit more this time. So that means that we don't have the same recorded expense because it was recorded in the period in which it was incurred, but we paid down some more that had been owed previously, perhaps. So that means that cash decreased, but we don't necessarily have it recorded in the expense side. So it hasn't come back out of net income this period necessarily. So again, if that's a little too confusing to kind of think through, just remember this. Changes in current assets, you do the opposite. For changes in current liabilities, you do the same. So if a current asset went up, you subtract it. If it went down, you add it. If a current liability goes up, you add it. If it goes down, you subtract it. Do the opposite for current assets, do the same for current liabilities. So accounts receivable went up 1,400. That means that I need to subtract 1,400. And we had, let's see, what were the others? Supplies decreased, prepaid insurance increased. So decrease, oh goodness, okay. Decrease in supplies, increase in prepaid insurance. Let's go back and check out how much those were for. That was 120 and 150. And again, we're going to do the opposite. So we add the 120, we subtract the 150. Let's turn these into some actual numbers here. There we go. Then let's look at our liabilities. We're going to do the same as these, current liabilities only. So we got accounts payable, salaries and wages payable, interest payable. So we had a decrease, an increase, and a decrease. So decrease in accounts payable. And I can't keep things in memory at all. So let's see, that was a decrease of 90. So we're going to subtract 90 here. Then we had an increase in salaries and wages payable of 35. And so we're going to increase or add that back. Then we had a decrease in interest payable of 32. So we subtract that. And that takes care of all of the operating section. So let's get a total here for our adjustments. Let's just total up this whole column. All right, now we take net income and we add this. If it was a negative, we obviously would subtract it. So that means overall we have net cash flows from, or you can put provided from, either way, operating activities. Okay. So in total, the operating side gave us $19,383.